Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit homegain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to homegain.com. Welcome back, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, and I'm joined today by Louis Cammarosano, the General Manager of HomeGain. Quick reminder, Real Estate Radio is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. Or reach us via the web at realestateradio.dcmetro.com. Before we went to break, Louis and I were discussing banks and them not wanting to lend money, and they're really not in business to make loans or in business to obviously to make a profit. Louis, it's interesting. Wouldn't you agree though that there is money to be made by lending, because the interest rates they're borrowing the money so cheaply right now that they could actually mark up their business loans, and instead of giving, maybe a 5% rate, they could charge a 7% and the business would still take it.
They can, but there's added risk to doing that, and if they can just purchase US Treasuries
that are basically tax-free.
Yeah, then they've made their money without doing anything, and they can then go ahead and spend money on their trading operations, which are much more lucrative.
Yeah, I mean, the paying such small yields on those treasuries, though, you would think that at some point they would. I mean, I guess they just feel like they don't have to take the risk right now, and they're not going to for the foreseeable future.
Right, because we don't know really. It's very hard to sift through their financials to determine how solvent they really are.
Right, I don't think anybody really knows. It seems like they're. I mean, all the news that we're getting lately, with Bank of America basically selling $500 billion worth of non-performing loans back to Fannie, and then you have, I've heard there's been recent rumors that actually Bank of America is looking to sell their correspondent loan division to another company. So I mean, there's a lot of writing that's on the walls that really I don't think there's something that's going to happen. I just don't know what.
And we also heard that the Fed is talking about purchasing mortgage-backed securities again.
Correct. Yep. So it seems like a lot of what's going on leads us to believe that the banks aren't doing nearly as good as they would lead on.
Well, because there's still a lot of excess in the system, and as we talked about last week, all that's happening is it's getting transferred. It's not really being liquidated.
Yeah, and there's a great article in the KCM blog, which it was showing the vicious cycle of foreclosures, and it starts with payment default. And then they said the good news with the payment default, the percentage of mortgage delinquencies has fallen dramatically off from last year. But the bad news is that we still have over 1.8 million homes in this category of people that have, not been paying their mortgage. Well, obviously, when they have been paying their mortgage, there's more foreclosures. Well, the good news is that there are less homes entering the foreclosure process right now than last year, but the bad news is we have over 2 million homes currently in the process. More foreclosures lead to what? Falling home prices. The good news is prices have stabilized over the last few months as foreclosures have been delayed, but the bad news is that experts are predicting that there's going to be another 5 to 10% decline in prices as the foreclosures are released to the market.
That's just another pause in the decline.
Right. And then lastly, that leads to a negative equity situation. You have falling home prices, which leads more people to be underwater. The good news is that there's less people underwater this year than last year. But the bad news is if prices continue to soften, and this will obviously be the same trend all over again, that people will be upside down in their home and they'll feel like they have to do something. They'll stop paying their mortgage, and it keeps going and going. And that's why, when you think about it, this can go on for a very long period of time.
Absolutely was going to be my comment, that by doing it, what the policies that they're engaged in right now, while they're trying to avoid a collapse and they're trying to avoid a short-term pain, are actually just prolonging the pain and dragging it out.
Yeah, and we can. I really think that
markets need to collapse. If that's the state of the market, it needs to collapse, and then it'll come back a lot quicker.
Exactly, it'll build itself back up
for 5 years.
Yep, it'll build itself back naturally. And all this artificial stuff that's going on, the stimulus, it's not doing anything. It's temporary measures. Like, they were
and it's costing a lot of money. And not only is it not doing anything, it's putting us further in debt and creating more inflation.
Absolutely, which we're going to feel the pain of down the road as well. And that's
You take your
that's
medicine now, or you take it later, but it's going to be a lot worse
Yeah, I do.
later.
I definitely agree with you there. Heading back to what happened in the market last week, Lewis, on Monday, the market was up big as troubles in Europe eased just a bit. Many of the troubles, if you're out there and you're trying to figure out, well, what does stuff going on in Greece and overseas have to do with us here? Well, we're in a global economy and everything kind of, it all is intertwined. So typically when we have stuff going on over in Europe, a lot of U.S. Money is tied up over there. And if we think that they're going to default, you typically what happens is you're noticing the stock market on our end is declining. What that typically means is more people are putting their money back into treasuries or just safe haven in the bonds, which is driving interest rates back down. So
Exactly. Now, what you have in Greece is the same thing. They won't just let it collapse, so they keep delaying and delaying and delaying, and it's not really helping. And eventually, it probably will collapse, and they should let those bonds just go under.
yeah, I know it's like
Get it over with.
get it over with and just whether you have to start your own system and break away from the euro, you have to do something. Inevitably, I think they all know that. And it's just a kicking of the can down the road, just as we're doing here in the United States.
And we all know that road is a dead end, and they keep trying to make the road longer.
I know it's really just when you think it can't get any longer, it seems like it just keeps stretching another quarter mile. You know what I mean? Like I would have thought that at this point everybody would just have come to terms with the whole Greece thing and just said just let it happen.
Well, look at what we did in Operation Twist.
Yeah,
They're selling the short-term bonds, and they're buying long-term with them.
as if these low interest rates aren't incentive enough to get people buying, there's just not the qualified buyers that are out there to take advantage of the low rates. It's not that they need to be lower.
Exactly, because if low rates and stimulus were the answer, we've had enough of that for 3 years.
And it hasn't done us much good, but
Nope.
drive us further in debt and prop up the chances of having a future inflation that's going to be through the roof. Um, on Tuesday, the Case-Shiller was reported that was showing an increase in home prices, which um, I'm thinking, on the national scale, like in the DC metro area, we've definitely been having an uptick in prices for quite some time now. I think that's going to go on for an extended period of time here, as we have a lot of government contractors, military operations within this region that are going to continue to promote home sales. I think that's going to continue here. Now in California and some other areas, it could be different. As I'm speaking about this area that I'm familiar with, I think that I'm seeing multiple contract situations all over the place now. So, and that really has to do with the amount of supply of homes that's out there, and it's really, really price range sensitive, Lewis. I mean, I'd say the majority of what's going on, 500,000 and under, stuff is moving relatively quickly. Once you go over that number, it starts to slow up a little bit. And a lot of that has to do with the lending the restrictions and tightening that's going on.
So you're going to have a robust job market in the D.C. area because most, as you mentioned, you have government workers and you have government contracts, and there really doesn't seem to be any sign of that slowing down. And they have the deficit reduction committee meeting at the end of the year, which means that'll be deadlocked and there'll be no cuts in federal government. And I heard that there's 6 Democrats, 6 Republicans, and the 6 Democrats are saying before we talk reduction, we have to talk tax increase.
Yeah.
So you know what's going to happen. That's going to be a deadlocked committee.
Yep.
And so basically that means that the money spigot in D.C. at least is going to continue.
Yeah. I mean, nothing's changing between now and next election. We might as well just come to terms with that now.
Which means that you won't have an improvement in the job market in the rest of the country, but it also means that the government's suspending that keeps the job market afloat in the D.C. metro area will continue.
Yes. Yep. It will continue. We're talking with Louis Cammarosano, the general manager of HomeGain. We're discussing what happened in the markets last week. Last Wednesday, business spending was up, which is a good sign that the economy might not be falling back into another recession, but I would take that with a grain of salt. Some businesses are doing better than others. Like I said, and it's really sensitive to the area. Like DC metro area, obviously, a lot of the business spending is up. Things are thriving a little bit more here than elsewhere. On Thursday, jobless claims came in. Application for jobless benefits dropped by 37,000 in the week that ended September 24th to 391,000, which was the fewest since April, the Labor Department showed. Economists forecasted that 420,000 claims, according to the median estimate in a Bloomberg News survey. I really don't read too much into this. I really think that we're going to actually see jobless claims keep rising. They're not going to be decreasing over an extended period of time.
That was just 1 week.
That was just 1 week, and I really think that it's going to go way up above 450. I think it's going to go into the 500,000 here before long. There's just so much negative stuff that's going on in the economy. I really don't see anything that's promoting job growth. So I would tend to think that these figures are going to get worse as time goes
But,
on.
even if the layoffs subside, that doesn't mean that hiring goes up.
Correct.
I
Correct.
think that's the real key because most companies are going through the 2012 budget and they're probably not including a lot of hiring. They may be somewhat done firing people for the year, and that may reduce the number of jobless claims in the next couple of months. But it doesn't mean that hiring is going to go increase in the next few months either. So your unemployment rate should probably stay around the 9% range, which isn't good.
No, not at all. And it's been there for quite some time now, and we haven't really seen a change in it for the better. That's anything significant.
Right, and also what they do with the unemployment rate is they stop counting people after a certain period of time. So
Yeah,
that
they
doesn't
fall
mean
off the
they're
sheet. Yep.
unemployed. Right, they're still unemployed.
Right. And that's a huge chunk of the population now at this point.
Oh, sure, you have people over 99 weeks.
Yeah, the
Which
99ers. Yep, you're right. And they don't, when you take those and you factor those guys out, I mean that's why I said the real unemployment rate is probably more towards 20%. Between like probably 16 and 20% because of taking into account those people that had been on unemployment insurance for that period of time.
And it's unfortunate whoever's unemployed, but for the general economy, young people are unemployed at greater numbers, which means they're not entering the market and getting job training.
They're not getting job training, and then when they go and do apply for jobs, then they have been maybe out of college for a year at this point or two. I mean, it's going to get harder and harder for them to get a job.
And by the way, they have a college loan they have to pay back.
Right, that's being deferred, and that period is slowly coming time to start paying on it.
So that keeps them in their parents' home, which means that they're not out buying homes in 7 or 8 years as they normally might be doing. That's going to push that group of people further out into the future as to when they might be buying homes.
Everything is a vicious cycle. It really
well,
is.
Everything, as we talked about, is pushing everything out, which is not the good thing to do. We should kind of let everything reset, and then it'll take its natural course. But when you keep pushing it out, this is what you're going to get. You're going to have a generation of people, 20-30%, who won't have a job for 3 or 4 years out of college.
I know it's not good news, but when we come back from the break, I do have some good news for veterans. If you're looking to obtain a home loan after November 17th, their easing of fees is coming about. So stay tuned when we come back.